If you're a complete beginner to investing, you're in the right place. In this video, I'm going to tell you everything you need to know about investing to take you from being a beginner to someone that has a clear action plan to getting filthy rich. Now, I also want to quickly address the people that haven't yet started investing because they're afraid to lose their money. So that's how much of Apple's profits you're entitled to based on how much of the company you own with your 1,000 shares. On the other hand, if you want to choose the second path, here's the type of results you could expect to achieve. This is just the truth about capital allocation. So now let's talk about how to know which companies to buy, and most importantly, when to buy them. All three of Buffett's criteria are important. However, if one had to be the most important, it's the third one. Before we get too much into it, I want to make you a promise. I promise you that by the end of this video, you're going to be feeling a little bit like this. I'm going to be going into a massive knowledge dump here in this video, and I promise you that you will get overwhelmed. We're compressing knowledge that it could take years to accumulate into the next 20 or so minutes, and it's important that you don't get too frustrated or nervous because you will get overwhelmed. I'm going to be covering so much stuff in such a short period of time, so don't be concerned about that. I promise you that it's going to happen, and it'll be worth it. All right, now that we got that out of the way, please give this video a thumbs up, and let's get into it. So first of all, why invest? Well, there's only two ways to make money in this life. One is to trade your time for money. And this is probably 99% of people. This could be you whether you're an employee or you're self-employed. Regardless, you're trading your time for your money. And then the second way to make money in this life of ours is to own assets that pay you money. Those are the only two ways. And some people might argue that there's a third way, which is trading stuff or flipping stuff. But I actually still put this into that first category. If you're making your money by trading or flipping stuff, you're still really just exchanging your time for your money. True financial freedom is when you can wake up and do whatever you want with your day every day and continue to earn the income you need from the assets you own, regardless of what you spend your time doing. So if that sounds like your goal, stick with me. So those are the only two ways to make money in this life of ours, and obviously we're going to be focusing on that second one, owning assets that pay you money. Now, my personal favorite type of asset for investing in, and it's the one we're going to be focusing on in this video, is investing in great businesses through buying shares of its stock. And most importantly, paying a good price for those shares. The other main options for assets you can invest in are one, buying rental properties, or two, lending your money out, which as a side note is also referred to as buying bonds if you're doing it through an exchange. Now for me, I'll choose stocks all day long as my investment of choice, and there's a bunch of reasons why, but the main one is just that I believe it's where I'll be able to get the highest returns on my investment capital. Now I also want to quickly address the people that haven't yet started investing because they're afraid to lose their money. The main thing I want to say to you is that if you put your money under the mattress, or if you put your money into your bank account, there is this insidious thing called inflation that will constantly erode away at the purchasing power of your money. Even though the numerical amount of money that you have will not decrease, the buying power that your money has is constantly decreasing because of this thing called inflation. And the reason for this is simply because new money supply is constantly being printed. And lately, it's being printed at an alarming rate. An easy way to see this for yourself is just to look at the price of homes. Homes have been going up by roughly 4, 5, or 6% per year on average. Well, in reality, and the way you should be thinking about it, is that the price of homes actually is not going up at all. It's the value of money that's going down. And that's why it takes more and more money to buy the same house. Not because the price of the house has gone up, but because the value of money has gone down. And this again is because new money is constantly being printed, which causes the value of every existing dollar to become worth less and less. And this is just a fact of life. So if you're afraid to start investing because you're afraid of losing money, just realize that there is a 100% chance of losing your money if you don't invest. So if owning assets that pay you money is the key to financial freedom, then naturally the first step is to start to accumulate these types of assets. As I've already mentioned, my favorite is shares of stock. So we're going to start with the fundamentals, and here's the first fundamental you need to know. Shares of stock represent an ownership interest in a company. So if somebody says they own shares of a stock, what they're really saying is that they own a piece of a company. For example, if you own 1,000 shares of Apple stock, because Apple currently has 16.823 billion shares outstanding, it would mean you own 1,000 shares divided by the 16.823 billion shares outstanding equals 0.0000059442443% of the company Apple. And that ownership entitles you to that percentage's worth of Apple's profits. Let's look at what that means. Over the past 12 months, the company Apple has made $57 billion $1,000 of profits. And by profit, I mean that's the money left over after all the expenses and taxes have been paid. So the 1,000 shares of Apple that you own would therefore entitle you to 57 billion multiplied by the percentage of the company that you own equals roughly $3,388 of those profits belong to you. So that's how much of Apple's profits you're entitled to based on how much of the company you own with your 1,000 shares. Now, some companies out there distribute all of their profits to the shareholders, aka the owners, and this is called a dividend. Apple, on the other hand, as of right now, distributes just 24% of their profits to its shareholders, which in our 1,000 share example here is about $813 of the $3,388 of profits you're entitled to. And this money is sent directly to you into your brokerage account as cash, and that's your dividend. You could go ahead and withdraw this cash out of your brokerage account and go buy yourself something nice. Or you could take that cash and you could reinvest it. You could buy more shares of Apple, for example, or you could buy shares of another company. And of course, the more shares you own, the more future earnings you're entitled to. And since step one on our path to financial freedom is to accumulate shares of stock, my suggestion would be that you do reinvest your dividends when you get them rather than spending that money. By using your dividends to buy more shares, you'll accumulate shares faster, obviously, and ultimately you'll reach your goal of financial freedom sooner. Now, we are going to cover how to know when to buy and which stocks to buy in just a second, but let me first tell you what happens to the other 76% of those profits that you're entitled to that aren't paid out to you as a dividend in this 1,000 shares of Apple stock example that we've been talking about. The rest of those profits are considered retained earnings, simply because they are retained rather than distributed as a dividend. Now, there are 4 ways that retained earnings can be used by the business, which are to pay down debt, reinvest back into existing operations, acquire new businesses, or buy back shares of its own stock. And it's the job of the CEO of the company to decide how to allocate the company's profits. So speaking of the CEO, you can think of him or her as your employee, because technically that's what the CEO is. They're the person you and the other owners have hired to manage the company on your behalf, and possibly even more importantly, to effectively allocate the profits of the company on your behalf. Now, it should be said at this point that not all CEOs are equally great at allocating company profits. Here's an example of a capital allocation decision. Option 1, should I use these profits to pay off debt that's costing us about 3% per year to carry? Or option 2, should I use the profits to buy this new machine that should give us about a 10% annual return on our investment? So in this simple example, option 2 is better because earning 10% is better than saving 3%. And as a side note here, just talking personal finance in general now, if you're a homeowner and you have a mortgage at 2 or 3% per year and you have extra money to either invest or put towards paying down the mortgage faster, it makes a lot more sense to invest that money and earn 5, 10, or 15% annual returns on that money than it does to pay down the debt that's only costing you 2 or 3% per year to carry. Now, I know this goes against conventional wisdom. However, this is just the truth about capital allocation. If that's confusing, let's flip the example around, and it works the same way as if you had credit card debt at 18%, for example. If that's the position you're in, it's going to make a lot more sense to pay down this credit card debt at 18% than it would be to put this money towards your mortgage that's costing you only 2 or 3% per year, or even to put this money towards an investment that could earn you 15% per year. Paying off the debt at 18% per year is the best place to allocate your money if this is the situation you're in. Understanding capital allocation and being a good investor go hand in hand. And like I said, not all CEOs understand this. The same company could achieve wildly different results in the long term depending on whether it's being managed and run by a competent CEO who understands capital allocation or one who doesn't. One of the biggest capital allocation mistakes a CEO can make is making a bad acquisition of another company. What makes it bad is they often pay way too much, so the resulting return on investment is just very bad. As a shareholder, you'd be upset because the CEO is essentially wasting your money. And if that were the case, you'd much rather have those profits distributed to you as a dividend so you can reinvest them yourself because, well, personally, and if you're a value investor, you're going to be able to invest that money yourself and earn at least 10 or 15% annual returns with it. One of Warren Buffett's main criteria that must be met before he'll invest in a company is that the CEO is competent. And having a good mind for capital allocation is one of the biggest determining factors as to whether or not a CEO is competent. Tim Cook, the CEO of Apple, is great at allocating capital, by the way. Here's a chart of his returns on invested capital results over the years. So to say the least, in the case of Apple, shareholders are very happy to have those profits retained and reinvested on their behalf instead of being distributed to them for them to then figure out where they'll reinvest that money. Now, although Warren Buffett wants a competent manager running the company as one of his criteria for investing, he has also made it very clear that when management with a reputation for brilliance gets hooked up with a business with a reputation for bad economics, it's the reputation of the business that remains intact. He also also says, and I'm paraphrasing now, that if you've got a really great business that basically has a monopoly over its market, then your idiot nephew could run the business and it wouldn't make any difference. So yes, a competent CEO that knows capital allocation is important for your long-term results, but owning a great business is even more important. So now let's talk about how to know which companies to buy, and most importantly, when to buy them. And by the way, do you feel like this yet? If you do, don't worry. You can always come back and watch this video again, and there's a lot of other videos on my channel that can help fill in the gaps as well. But not only that, but I'm gonna respond to every single comment I get on this video, and I'm happy to help answer your questions, so please don't hesitate to comment and ask away. So Warren Buffett has 3 main criteria he looks for before buying a business. And by the way, the criteria are the exact same whether he's buying a business in whole or in part through buying shares of stock. It doesn't make a difference one way or the other. The criteria are the exact same. Number 1 is that it's run by competent and honest management. Number 2 is that it possesses favorable and durable economic characteristics. And number 3 is that it needs to be purchased at a sensible price. So we've touched on number 1 a little bit already, and now let's talk about number 2 and number 3. So what does it mean for a company to possess favorable and durable economic characteristics? Well, to answer that, let's look at another quote by Warren Buffett. He says, "The single most important decision in evaluating a business is pricing power. If you've got the power to raise prices without losing business to a competitor, you've got a very good business. And if you have to have a prayer session before raising the prices by 1/10 of a cent, then you've got a terrible business." I've been in both and I know the difference. When Warren Buffett talks about a company having favorable and durable economic characteristics, or sometimes he calls it an economic moat, he's referring to a company having pricing power. Now, I just did a video with a friend of mine who I consider an expert on pricing power, and in the video he describes it very well. So instead of rehashing it right now in this video here, I'd suggest you check that one out at some point in the near future. And actually, eventually I'm planning on doing a video dedicated to pricing power, so definitely subscribe if you don't want to miss that one when it comes out. All 3 of Buffett's criteria are important. However, if one had to be the most important, it's the 3rd one. The purchase must be made at a sensible price. And this is really why it's called value investing. As a stock investor, it's your job to value companies and then only buy if it's available at a sensible price. That's what you do as an investor. You spend your time figuring out what businesses are worth, and then if you can buy for less than it's worth, you buy it. Let's do an example now and value a small bakery business. And to make it simple, let's say that we know that this business will earn exactly $10,000 per year, every year, going forward into the future. Now here's the thing. Collecting $10,000 every year for, let's say, the next 50 years is not the same as receiving $500,000 right now, right? Because if we had $500,000 right now, we could invest that money and have much more than $500,000 in 50 years from now. So how do we figure out what those future earnings are actually worth today? To keep it simple again, let's assume that you have the ability to invest your money and earn 8% annual returns. This is the amount by which we're going to discount those future earnings by. So let's just start by figuring out the present value of that first $10,000 of profit you would receive in a year from now if you bought the business right now. The math looks like this. You take the $10,000 and you divide it by 1 plus the discount rate of 8%, which equals $9,259. In other words, if you had $9,259 right now and you invested it somewhere that would earn you 8%, after 1 year, you'd have $10,000. So $9,259 is the present value of the first year's earnings at a discount rate of 8%. Here's how the math would look for the second year. $10,000 divided by 1 plus the discount rate of 8% to the power of 2 equals $8,573. So now let's just go ahead and put this all into a spreadsheet to make it easier. And what we find is that earning $10,000 per year for the next 50 years is worth about the same as $129,000 today. That's the sum of the present value of all those future earnings. That's the value of this business. In other words, owning this bakery that is guaranteed to generate $10,000 of profits per year has the equivalent value as does having $129,000 of cash in our pocket right now. So that's what this company is worth. And it means that if you're going to be following Warren Buffett's 3rd criteria of only buying at a sensible price, then we'd want to be paying no more than $129,000 for this business. But that's not all, so keep listening. Continuing down this train of thought, so if somebody offered to sell you this business for $100,000, would you buy it? Well, of course you would, because it's worth $129,000 after all, right? But the problem is that I made it way too easy for us. See, in real life, companies don't earn the same amount every year, year after year. Earnings could decrease for all we know, and they could also increase. And then there's the issue of the company's lifespan. I've used 50 years for this company, but how are we supposed to know how long this company will actually exist for? And then finally, there's the discount rate. We used 8% in our example, but in the real world, this is really just a guess as well. So really, to value a business any business, it requires a lot of guesswork. Okay, now one possible solution is to say, okay, since the real world's future earnings aren't guaranteed, maybe we should be more conservative and discount them by more than 8%. So following that logic, if we used a discount rate of 10% rather than 8% to discount those future earnings, then we'd find that the present value of those future earnings is actually now only worth just $106,000. Uh-oh. All of a sudden, paying $100,000 for this business is now a much less obvious decision. And furthermore, what if instead of the bakery earning $10,000 per year consistently year after year, what if instead a competitor came along and set up another bakery in town and now your profits actually started to decrease by 5% per year? Well, now using a discount rate of 10% and with earnings decreasing by 5% per year, we calculate that the business is worth just $70,000 today. Yikes, now I wish I didn't buy this business for $100,000. Valuing a business is sounding more and more like a very difficult task. Well, here's what I can tell you about that. Yeah, there's some challenges, but personally, they don't dissuade me, and I'll tell you why. Warren Buffett's teacher, Benjamin Graham, had one golden rule for investing. He said, you have to invest with a margin of safety. And ultimately, all he really meant by this was just that you have to use very conservative estimates. Quite frankly, a good investment will be very obvious to you, and you won't have to do any of this math in a spreadsheet or anything like that. For now, consider using a spreadsheet and doing a present value calculation like this, sort of as training wheels. Eventually, you can take the training wheels off. Warren Buffett and Charlie Munger, they don't use a spreadsheet like this. They just buy when it's an obviously good investment. And in time and from experience, you'll get to this point as well. Now at this point, I have two paths for you to take. Path one is you just decide all of this is just too hard and you want an easier way that requires zero effort, and there is such a way. And if that's you right now, I don't blame you. This is the best path for most people because to become good at investing, you need to have a real passion for business and investing. And if that's not you, then you're probably going to be better off just taking this easy way approach. For those that want to go down this path, I made this video here that explains my suggestions for the easiest way to get the best results that requires zero effort from you. On the other hand, if you want to choose the second path, here's the type of results you could expect to achieve. The best investors can achieve somewhere between 12 and 20% annual returns on average over a long sustained period of time. In contrast to that, investing in an S&P 500 index fund will earn you somewhere between 7 and 12% per year. And my personal guess would be on the lower end of that range for the next couple of decades. And here's what the difference would look like after 30 years of compounding your money at these various rates if you're contributing $10,000 per year to your investments. At a 7% compounding annual growth rate, your money will grow to $944,000. At a 12% compounding annual growth rate, your money will grow to $2.4 million. And at a 20% compounding annual growth rate, your money will grow to $11 million. Personally, I have been able to achieve great results so far, and I do strongly believe that I am going to be able to achieve my goal of 20% on average per year. So far, I have been able to do this, and just to give you a glimpse of that, here's how one of my accounts did in just 2020 compared to the results of the S&P 500 index. Now, obviously, this won't be an every year occurrence for me, and nor could anyone expect to achieve these types of results consistently year after year, but it does give you an idea of what a good year can look like for you. Just a reminder now, by the way, I'm not a financial advisor. I'm just someone who loves investing and loves business. So this video and any of the content that I put out there anywhere should be enjoyed as entertainment and not as financial advice. If you're looking for financial advice, you should seek out a local, qualified professional. You might be wondering at this point, why on earth would a business trade for and be available to buy at a price that is significantly under its true intrinsic value? And the answer to that question is what I think you should be learning about next, and it's the first video in this playlist here about the most important chapter of the most important book on value investing. I've put two playlists on the screen. One for those of you that want the easy mode way to get the best results with the least amount of effort possible, and the other for those of you that want to continue down this value investing path that we've been talking about. Either way, I'll see you in the next one.